So, in the world of investing, especially when learning and getting started, it can be discouraging to make mistakes. This causes many people to walk away, and while investing is not for everyone, it is important to understand that everyone makes mistakes. So, today, I'm going to look into some of the biggest mistakes Warren Buffett, the Oracle of Omaha, has made, and the kind of traps he has fallen into, as well as how to avoid these as an investor. So, stay tuned. Hi, everybody, welcome back to The Contrarian. My name's Logan. I really like to talk about overall success in investing, as well as going against crowd thinking mentality and just the kind of the common mistakes that the crowd makes. And in doing this, you will be able to outperform the markets over time, not necessarily year to year, but definitely over time. So if you like these kinds of topics, just consider subscribing. And I also want to make a brief disclaimer that none of this is to be taken as financial advice. So thankfully Buffett is very honest about his mistakes, and he basically, it's because he has to be. He's the CEO of Berkshire Hathaway after all. You know, he needs to walk his clients through every decision he makes, and he's accountable to them. So by definition, if he makes a mistake, he needs to disclose these to the public and really discuss what kind of trap he fell into and what mistake he made mentally. So key takeaways: Warren Buffett is widely regarded as one of the most successful investors of all time, but even the best investors make mistakes. And as you'll see, basically all of these mistakes that I talk about that he's fallen into are very common mistakes. You would think that Warren Buffett might not make common mistakes, but in fact he has. So it shows that even the best people within a specific career or sector even do fall into very common mistakes. So I just want to make that clear. Buying at the wrong price, confusing revenue growth with a successful business, and investing in a company without sustainable advantage are all mistakes that Buffett has shared with his shareholders in the legendary annual letters to them. And among the companies that Buffett names as his biggest investing mistakes, he includes ConocoPhillips, U.S. Air, and Dexter Shoes. So let's start off with ConocoPhillips, and this mistake was buying at the wrong price. In 2008, Buffett bought a large stake in the stock of ConocoPhillips as a play on future energy prices. I think he may agree that an increase in oil prices is likely over the long term and that ConocoPhillips will likely benefit. However, this turned out to be a bad investment because Buffett bought in at too high of a price, resulting in a multi-billion-dollar loss to Berkshire Hathaway. The difference between a great company and a great investment is the price at which you buy stock. This time around, Buffett was even more wrong, since crude oil prices were well over $100 a barrel at the time. Oil company stocks were way up. Lesson learned: it's easy to get swept up in the excitement of big rallies and buy in at prices that you should never have in retrospect. Investors who control their emotions can perform a more objective analysis. A more detached investor might have recognized that the price of crude oil has always exhibited tremendous volatility, and that oil companies have long been subject to boom and bust cycles. And Buffett says, when investing, pessimism is your friend, euphoria is the enemy. And I could not agree more with this statement. As you can see, Buffett fell in with following the crowd, essentially, on this mistake he made, and it's kind of, I'm sure it was, kind of humiliating in some ways for him to admit this mistake, but yeah, it just shows that even the best investors, the best people within a given sector can make very obvious seeming mistakes in retrospect. This is kind of a side note, but I see a lot of this going on right now, people buying what could be a good company, but just a way overvalued price. It's not very hard to find examples of that in the stock market right now. So let's move on to example number 2, which is U.S. Air. And the mistake he made here was confusing revenue growth with a successful business. Buffett bought preferred stock in U.S. Air in 1989, no doubt attracted by the high revenue growth it had achieved up until that point. The investment quickly turned sour on Buffett as the U.S. Air did not achieve enough revenues to pay the dividends due on its stock. With luck on his side, Buffett was later able to unload his shares at a profit. Despite this good fortune, Buffett realizes that this investment return was guided by lady luck and the burst of optimism for the industry. And the lesson learned: as Buffett pointed out in his 2000 letter to Berkshire shareholders, sometimes businesses look good in terms of revenue growth, but they require large capital investments all along the way to enable this growth. This is the case with airlines, which generally require additional aircraft to significantly expand revenues. The trouble with these capital-intensive business models is that by the time they achieve a large base of earnings, they are heavily laden with debt. This can leave little left for shareholders and makes the company highly vulnerable to bankruptcy if business declines. Buffett says, investors have poured money into a bottomless pit, attracted by growth, when they should have been repelled by it. And again, this is such an important statement to pay attention to. I see so much of this going on as well right now. People buying into these growth companies that are extremely in debt and that have extremely low earnings, if earnings at all, just buying into this growth narrative. And it's so important to realize that growth can go away extremely quickly, and then you're essentially stuck with a terrible business. And it's also important to realize, I think, that making a mistake in investing doesn't mean you will necessarily lose money. It just means that as an investment, as a long-term investment, it wasn't a good decision. As Buffett, pointed out, he did end up actually probably making a little bit on this position he had, but it still was not a good long-term investment. So, yeah, just because you make a mistake doesn't mean you will lose money. Moving on to Dexter Shoes, his third mistake, investing in a company without a sustainable competitive advantage. In 1993, Buffett bought a shoe company called Dexter Shoes. Buffett's investment in Dexter Shoes turned into a disaster because he saw a durable competitive advantage in Dexter that quickly disappeared. According to Buffett, what I had assessed as a competitive advantage vanished within a few years. Buffett claims that this investment was the worst he has ever made, resulting in a loss to shareholders of $3.5 billion. Lesson learned: companies can only earn high profits when they have some sort of a sustainable competitive advantage over other firms in their business area. Walmart has incredibly low prices. Honda has high-quality vehicles. As long as these companies can deliver on these things better than anyone else, they can maintain high profit margins. If not, the high profits attract many competitors that will slowly eat away at the business and take all the profits for themselves. Buffett says a truly great business must have an enduring moat that protects excellent returns on invested capital. Again, this is a very important thing to take away if you don't want to fall into this mistake that Buffett did, is just to find a company that has a durable competitive advantage, and that's much easier said than done. I would say there's not very many companies I've seen that I would say have a truly durable competitive advantage. So that really can be something that really weeds out a lot of potential investments for you to look into. And now the last mistake I'll talk about occurred even more recently in the last year, and that was when Buffett sold all of his positions in the four major airlines: American Airlines, Southwest Airlines, Delta, and United Airlines, and a lot of these were at major losses. I guess the key takeaways from this decision Buffett made to sell, he confirmed that he sold all of these positions. And in his own words, the world has changed for airlines, and that the industry has been really hurt by forced shutdown due to the virus. With the pandemic effectively halting global air travel, U.S. airlines are now receiving portions of $25 billion in federal grants alone. So I think what Buffett was pointing out to is that even though these airlines were temporarily being bailed out, it's just the world for the airlines had really changed as a result of this shutdown, and I don't think he was wrong in this. Even though the stocks have recovered since he sold them, he could have sold them at a higher price than he did. It just shows that once your original thesis for buying into positions changes, you really want to get out of them as quickly as you can, even if you think they might recover based on some temporary grants given to them. It's just not going to play out well in the long term. That's the most recent mistake Buffett has made, and that was a big shift for him in the last year, was selling all of these positions. He'd bought them just 4 or 5 years ago, so that was a pretty big shift for Berkshire Hathaway. So the bottom line from this video is that in the investing world you will make mistakes, unfortunately. And I've made mistakes, and they can be very discouraging. And however, you need to learn from these mistakes and not fall into these very common traps that the crowd of investors is falling into. I think a very common thing that will set you apart from most other investors is learning from your mistakes and not making them again, and recognizing them when they pop up again, even if they pop up in a different way than they previously did. So when you do make mistakes, just try to learn as much as you can from them. And even though they do cost a lot, they're just so valuable to learn these lessons. And oftentimes, as they say, the best lessons you learn are the hardest ones. So yeah, that's a simple fact. It's the reason why Buffett has been able to outperform the markets over the long term. He's not generally fallen for these traps, and when he has, he admits them and he learns from them. And in the future, he does his due diligence as to looking into his investments, and he, generally doesn't make these same mistakes again. So, yeah, if you guys like these kinds of topics, just consider subscribing if you think I've earned it, and I hope to see you again.